bond. Right. So in your in Europe, right, your price that would be accrued interest that would be added in the price of the bond. So that is how your bonds are traded in Europe. However, if you look at some other market like US, so you will see this accrued interest is not added in the price of the bond. Right. So, so then it will be clean price. So clean price basically means there is no accrued interest. Right. So that means the clean price. So without the interest part being added to the bond price, so that is called your clean price. So when it is being traded with the clean price, you would require as an investor, you would like to take your interest which is accrued on the bond. So that is when the things are complicated, and whenever you're selling a bond, you are selling with this accrued interest. So the buyer of the bond would also be paying the accrued interest along with the price of the bonds. So look at this now. So if you see calculation of dirty price, so that means accrued interest you can say. So this becomes the actual price of the bond. So face value, what is the face value? That is 15,000, and then the fair value of the bond is 101. Fair value is basically a method to calculate, ascertain, or to find the current value of the bond. That is called your fair value. So it is used through a discounting method. So 101 as in is the fair value which is given there in the beginning only. You would have seen there. No, it is there. Yeah, this is given there in the beginning. No, and the face value is already given. All these terms are already given to you. The fair value is taken into consideration when you try to find when you're doing the discounting, right? So you're trying to come up with the current value, right? So the bond has got a maturity in future. So you're discounting the value of the bond in in today's time. So that is how you calculate the fair value. So 101 is the fair value. So with that you come up, you add this, you know, you add this value of the price accrued, and you see the exact value, the exact price of the bond is 15,287.50, right? Similarly, when you look at from the other price point of view, then this amount will vary differently accordingly. Right? Any doubt here? Any question? Yeah. You may take maybe 2 minutes if you want to go through the slides, and just take 2 minutes. Just scan through the slides that we just discussed. If you need any explanation, or you find with that, then we can move on. Any one of you, as in anyone from your batch who is not from the commerce background?
Even I am not from the commerce background, but I have 3 years of experience in banking, and I have also done MBA in banking and finance.
Okay, Chunky, okay, fine. So you're not from the commerce background, but you have got 3 years experience into banking only, right?
Yes, sir. And also
Okay,
banking, a diploma in banking and finance from Manipal, Bengaluru, and
okay,
I have also done risk management.
okay, okay. So that way you are comfortable with all these
Yes,
concepts,
yes,
right?
I have no. I'm not finding it difficult to connect.
Yeah, yeah, yeah. Especially usually people who do not have commerce background or
And
no finance background, they might find it a bit tricky in the beginning.
sir,
But
I have also done this NISM from mutual fund and depository, so things are pretty connected with
oh,
those
okay,
things.
Absolutely, yeah, that's great. So you have got quite a good interest in all these things.
Sir.
Then
Yes, sir. I just wanted to change from Indian banks to investment banking. I'm trying since 3 to 4 years, but struggling. That's why I
okay,
came here.
no, it makes sense because when you already have an interest or also done couple of certification like the NISM and the banking and diploma, then it is a good move, I would say, because if you get an opportunity, and many students have already uh, follow the same approach in order to change the path or the career trajectory. So it's a right move, I would say. That way you can
Sir.
probably lend uh, into as in the multinational banks which are there, and that way.
Exactly, sir.
So did you get it as in did you do you have some referral from the Marticus, or how did you get to know about Marticus?
I came in contact with Prakhar, sir. Uh,
Oh, okay. I was thinking some
Sir,
because
actually, he mentioned your name also. He do stay in touch with Amit sir, and also other than that, he also did diploma in banking and finance
yeah.
from Manipal also.
Yes,
So
yes. Pratham was as in he was in my previous batch, so I know him. So I that's what I was thinking. Like maybe you got reference from somewhere. Okay, fine. Okay, that's great. Professor joined. I guess he has joined Bank of America now.
exactly, sir. I talked with him last week. So he told me that he was in Saxo Bank, and later
Yeah,
on,
yeah. He joined Saxo Bank initially. First, I guess it was a contractual agreement. It was renewed, or by the way, it was renewed for another 6 months. That's what I got to know while I talked to him. But before that, he got this you know Bank of America one, so there was no point of him continuing with the sector, right? So that's why he left it. Mm, okay, okay. So let's move on. One second. So okay, the clean price and dirty price. These are two things which will always confuse you whenever you are dealing in bond and all. People will say dirty price is not included. Is dirty price is included? Is clean price it is without dirty price? All these terms would be there, so don't find it difficult. It's very straightforward, very simple to understand. At times just people find it difficult. I don't know why they find it difficult, because it's very simple. Clean price, what dirty price is, clean price plus accrued interest. And what clean price is, it is without the accrued interest. If you remove it, then it becomes a clean price. That's it. It's simple as that, right? So similarly, as we did, what's the relation between your the earlier one that we did? Now here you got the relation between equity and bonds, right? So equity shareholders are the owners of the company. Bond holders are the creditors of the company. Returns on equity is dividend. Returns on bond is coupon, right? So equity has no maturity date. Bonds have maturity date except perpetual bonds, right? So equity shareholders have voting rights, and bond holders do not have any voting rights. Equity is traded over an exchange. Bonds are mostly traded on OTC market. At the time of winding up, equity shareholders are paid after bondholders, or rather, I would say in the end. And at the time of winding up, bondholders are paid before equity shareholder, rather first in the sequence of payment. You can say the bondholders are considered first for the payment of their obligation or their credit which they made to the borrowers or the issuers of the bond. Right. So these are the fine differences which are given there. Nothing's as in nothing's new, I would say. It is something that we have already as in discussed while we were covering this presentation. These points we have already done, but just the points have been given in one PPT so that you can probably remember them, and when there is a question around it, you can just answer like this. That's the motive of having it there on one page. So now this is given the trade economics. So how a trade, fixed income trade looks like. When I say trade economics, so trade attributes in short. Trade attributes means what is trade date, settlement date, and what's the notional amount, all those things are called trade economics, or you can say trade attributes in other words. So like additional terminology for fixed income: principal amount, total amount invested by a bond holder on the bond, number of years. So you can say number of years of maturity, that means the tenure of the bond. You can say 1 year, 5 year, 20 years. Coupon rate, interest amount paid to the bondholder. Coupon frequency means how the payment is made, quarterly, semi-annually, or it is annually. So that is how the coupon frequency is there. Day count convention, as we discussed, how the payment calculation would be done. The 4-day count convention that we discussed: A upon actual by actual, actual by 365, actual by 360, and then 30 by 360. So these are the various four day count conventions that we have, right? So type of bond, what kind of a bond is that? So very few, maybe I don't know, like if you know about this application called Bloomberg. So Bloomberg terminals are usually installed with as in most of the financial institution use Bloomberg to refer to the price detail and all those details of a bond. So, and there you will find all these details. Maturity you will find, and you will find type of bond, clean price, and all this information you would be able to find from the Bloomberg application. When you punch in the IC number, and you can easily access all the details, maturity, and all those details are readily available there on the Bloomberg platform. So this detail is required when you're going to trade with your client, right? So that is when you would require all these details. So usually systems populate these details automatically. So the moment you punch in the ICN detail, all these details are auto pulled from the system, because it is all automation. It is not a manually you're going to punch in all these details. Systems are clever and smart. So the moment you have an ISIN punched or entered in the system, the system will take all those details automatically: haircut, price, and all those details will populate in the system automatically. Any idea what is haircut? Anyone has heard about haircut before? No idea? Okay, no worries. Haircut is called your valuation percentage, right? So valuation percentage is like, just to give you an example here. So when you reach out to bank, just take an example, you're going to bank to take a loan against your property, right? So when you go and buy a loan against the property, so what you would be having in your mind, you would be going with this idea or this thought, like your property is worth 50 lakh rupees or 1 crore or whatever, right? So that would be your valuation or assessment of the property value, right? So while you reach out to the bank, so you will say, my worth of the property is 50 lakh rupees. But your bank would be saying, yeah, we understand and we do assess your value is close to 50 lakh rupees. But we are going to apply a haircut of 5%, 10%, and therefore we're just going to pay you a loan worth 45 lakh rupees. So just take the same example that we're discussing. You go to the loan, 50 lakh is the valuation from your point of view, and 50 lakh is again the value of the loan from the bank's point of view. But bank is saying, no, we are going to give you a loan of 45 lakh rupees, though we understand your point and your value is worth 50 lakh rupees, but we're going to apply a haircut of 10%. And by way of that, your loan sanction amount would be only 45 lakh rupees, not 50 lakh rupees. So you see there, this particular example that we discussed. So 50 lakh rupees is your total value, but you just going to get 45 lakh rupees. So reason you're going to receive the 45 lakh rupees is the same, because there is a haircut applied. So that haircut is applied to ensure there is no risk to the bank. There is no risk to the bank. So just to show you on the Excel file, you can, I will give me a second. The same thing. 1 second. Let me open the Excel file. Okay, so let's to understand haircut. 1 second, let me share my screen. Just let me know if you can see. Can you see the Excel file?
Yes, sir.
Okay, cool. So, so we're talking about haircut. Okay. So let's say the uh, house property valuation is 50 lakh rupees. Rupees 50 lakhs. You go to the bank and this is your valuation, right? So I say your property valuation is this. And what is bank valuation? Bank valuation is also they see it is rupees 50 lakh only. So the valuations are same. But while they are dispersing, the loan disbursement is rupees 45 lakhs. Right. So they're not going to disperse your entire 50 lakhs. They're just going to disperse 45 lakhs. Why they're doing so? So the reason bank is applying haircut. And how much haircut is being applied? You can calculate that. So 45 divided by 50 and multiply by 100, right? So 9% haircut is being, how much is that? Oh, what is that coming? So you can say 9% haircut is being applied. So rather it is 10%. So I would say because it's very clear, 10% haircut is applied, and you would say haircut amount percentage is 10%, right? So so now the question is coming, why bank is applying this 10% haircut? Any idea why the bank is applying 10% haircut? Or 10% is just a number. In this case, it is not necessarily always the 10% would be applied. It can be higher, it can be lower also, depending upon different situation to situation, and different matters will have a different way of haircuts and all. So that is how it will be there. So what are your understanding? Why the bank is applying haircut? Why bank is not able to disperse the whole amount? Any thoughts? Anything you
The
know?
bank is actually minimizing his risk. So what they are doing are they are taking into consideration the inflation recession factor into before lending. So that is why they are applying a haircut of 10% because the property price might get reduced or might get increased, something like that. That is why they are doing like this.
Right, absolutely. That's rightly said. So the bank is going to minimize its risk. Bank cannot give you the complete value of the loan, and the reason is there can be chances where can be the price the property price falls, right? If that happens, there is a risk to bank because bank has already lent you the complete value of the loan. So if in case the value falls drastically, then it is a risk because the value of the loan goes down. So then that means the paper, the which the bank has in its name, as in your loan property papers. So even if bank would like to sell your property in the open market, the bank would not be able to recover the full money if the borrower defaults against the law or the loan, or does not want to make that payment, the irregular interest payment. So that is the reason the bank would not like to would not like to leave things for its future exposure or future risk, you can say. So to avoid that future exposure, the bank would always like to apply a certain level of haircut on the loans which are sanctioned. So this is just a very common example I've shared. This thing is applicable for the securities, the one that we're talking. The securities can be your normal bond issues, it can be mortgage-backed security, it can be asset-backed security, whichever security you talk about. So haircut would be applicable. And haircut depends on two things largely. One, haircut depends on two things. The two major broad reasons I would say. One is the maturity, right? Maturity of your loan. And second is credit rating of the borrower, right? So if somebody asks you what are the drivers of haircut, so haircut are broadly defined is these two factors are taken into consideration while haircut is decided. So 10% is just a number which I've given you, but this 10% can vary situation to situation depending upon the condition that we're talking here. So if the maturity of the loan is high, is more, then the haircut is expected to be more, because longer the maturity, longer the uncertainty, you can say. Shorter the maturity, shorter the uncertainty in the valuation, you can say. So there would not be any there would be less chances of valuation going drastically low, right? So market if are at the stable level, and the maturity is just left for a year or so, so you can probably see, or things would be visible in a better manner, like how market is going to react or respond, and that is how you would be able to give loan at a better haircut, means you would not be charging higher end haircut, rather than situation when the loan has got 20 years of maturity, right? If you are going for a loan against property for 20 years, so that means the maturity of the loan is quite long, or it is for 20 years. The duration tenure is longer, right? So when the tenure is longer, you can say the risk is high. When the risk is high, for sure, the haircut charge would be high, right? So that is how. And then the next is the credit rating of the borrower. So whoever is taking the loan from you, so the how is the credit rating of the borrower is also another factor, which is going to determine the haircut of the particular transaction or the loan that we are talking at the moment. Okay, so that is from the haircut point of view. You just need to just keep this in your mind, how haircut is determined, why the haircut is taken. So this is at times as in the interview you can be asked. Okay, so these are the trade economics. So how a trade looks like from the profit and loss point of view, like say there would be trade date, economic details given, notional amount, commission from the brokerage point of view. Interest rate is your coupon interest rate, currency, maturity, customer ID, profit and ICAG. These are internal system reference numbers. So RMS system stands for risk management system, you can say, where the front office is going to book all the trades which they are doing with their counterparties or clients. So those trades will go into risk management system. Then it is given you day count convention. So how? Okay, one second. If my screen is visible, not visible. One second.
No, sir.
Okay, so this is how profit and loss calculated on bond. So your RMA system is your risk management system, which front office traders use, and in this system, your securities are captured, right? So that system will have ticket number, that will have the currency of the trade, interstate, and all those information would be highlighted. So as such, you do not need to remember anything. It is just to show you how a trade looks like in a system and what all things would be there. So commission would be shown. What is the commission charged on the transaction, right? So what is the notional amount of the trade? So that would be given there. What is the notional amount? Any idea? What when you say notional amount? So what is notional?
Amount which is invested, the actual amount which is invested.
Yes. Yeah, you can say notional amount is the amount on which your trade you have taken a trade. So as long as trade is not settled, that is called a notional amount. So when you have made a full payment or full payment you have made, so then it is no more a notional amount. It is the complete amount. So notional is from the point of view when you're taking a position on trade. So and especially when a trade is not settled, that point in time that would be called the notional amount. So once it is settled, so that means you have made the complete payment. So that becomes your the settlement or amount or the complete amount of the trade. So that is how the notional, especially notional, is more relevant when you do the derivative and all. Derivative have all maturities or settlement in future, right? So that is how it is. Commission given, commission percentage is given, all these details are given. Okay, now coming to this concept of securitization. So securitize, what is securitization? Process of taking an illiquid asset or group of assets and through financial engineering transforming them into tradable security. Right. So this is the definition of securitization. And securitization, just to make you understand securitization in a very common manner or in a very layman manner. So let's look at from this point of view. So you or you know there are uh, a lot of people who take home loan from bank on a regular basis, and when a loan is taken from the bank, what a bank does to those loans? Bank has got a lot of loans in its balance sheet, and the loans are, it is kind of a,
Secured loan.
yeah. Any question, guys?
Nothing, sir. I'm just telling that these loans, the loans lent by banks are secured loans,
Yeah,
basically the home loans.
right. Yeah, right. These loans are secured one because the loans are issued against the property only or the land, right? So then you will call these loans secured ones, right? Now, what a bank is doing as a commercial bank, right? So commercial bank is largely responsible. Investment bank does not issue home loans and all. It is a commercial bank who is doing this issuance of loans, and they are doing the issuance of loan on the basis of the deposits they have got, right? So at the one hand, bank has got deposits from its customers, and on the other hand, the bank is sanctioning loans to uh, to the other segment of the customers. So whoever required a home loan, they are getting the loan. Right now, we're focusing on the home loan only, but there are various other kind of loans are also sanctioned by the bank. Personal loan, automobile loan, right? So all other kind of loans are given by bank. So that keep it aside at the moment. Let's focus on the home loan because we need to understand the concept well, and then we will talk about the other loans also. So bank is going to issue those loans to various customers. Now, when you issue loan, you're going to make payment to the customer. That can be a that is a one-time payment. It can be a construction link payment. There's a different kind of loans available, right? You might be aware. So that is how the bank makes those payments. Now, all those loans are kind of it is kind of a risk to the bank because if some borrower does not make that payment, then what will happen? The bank is going to show that into NPA, and then there is non-performing asset. You might have heard this term, especially the guys who are working in banks. They definitely be knowing the term NPA. It's quite often talked about, right? NPA and all. So, so it is, if you as a borrower do not make that payment to the bank, So it is a risk to the bank. So what bank, and at the same time, one, it is a risk to the bank. At the same time, if you have got deposits at the one hand, at the other hand you're issuing loan, so there would be a situation at some point in time wherein you would not be having enough money to issue those loans, right or wrong. So you not, deposits are there, the deposits are also in certain number only. So it is not there is a constant flow of money which coming every day and you would be having so much surplus money that you will continue issuing loan without realizing that there is this limitation of money also. That is not possible, right? So banks also have a limitation of money, and they know to make the whole system efficient, they will have to come up with some innovative solutions. So this is one of the innovative solution you can certainly say from the bank's standpoint. So bank when is issuing loan to the people, so they have got papers, all those papers which are in the name of the borrower to whom they have issued the loan. So what a bank does, uh, bank reaches out or talks to another bank, which is a finance investment bank, and that investment bank uh, agrees to pool all such loan in one special purpose vehicle, right? So this special purpose vehicle is in an investment bank, and or your underwriter, you can say, like in case an IPO we discussed. So in the IPO also there is an underwriter. Underwriter is an investment bank. So this this investment bank will make or will pool in all those loans which a commercial bank has got, and those loans will be pulled in, and a special purpose vehicle is made. This special purpose vehicle is made for a special purpose. So converting all those loans, kind of these loans are being sold to this underwriter, to this investment bank, right? And once this is done, the investment bank further sells the same loan by making a tranche. Different tranches are made by, you can see, probably you can see this screen here. So issuing agent special purpose vehicle is made. This special purpose vehicle is then sold out in capital market to investors, right? And so that is, first they make different tranches. Who is making that? This is the underwriter is making these tranches. One tranche, first tranche is called the senior tranche. Then middle tranche is called mezzanine tranche, and the junior one, as in the last one, is called junior tranche. In most of the cases, or in some of the cases, or most of the cases, whatever way you want to call it, you can say the junior tranche remains with the bank. So uh, bank means the commercial bank we are referring here, not the investment bank. So all other, this pool of loan has been taken. So this vehicle is made, and when this special purpose vehicle is made, it is made out of those loans which were there in the balance sheet of a commercial bank, and this special purpose vehicle is further converted into in the same asset is made in the form of securities, and that security is then available in different tranches. There is a senior tranche, there is a mezzanine tranche, and there is a junior tranche, right? So now these tranches are sold out to the investors. These tranches, you can say, is sold out. And to understand this, when we say senior tranche, mezzanine tranche, or junior tranche, so senior tranche is the one which is the most safest out of these three. When I say most safest, means the credit rating is good on the senior tranche compared to the other two tranches. So chances of default are less for the senior tranche compared to mezzanine tranche, and similarly, relatively, it is less likely the mezzanine tranche will default compared to your junior tranche. So the junior tranche is the riskier one, where the credit risk is high, right? So that is how these securities are sold out in the uh, financial market to the various investors. And while doing this process, one, the bank is able to make money, right? And because banks need money to issue more such loans outside. And at the same time, bank is also able to get rid of its liability of owning those loans which they have issued in the first place. So in this particular example, if you see, the bank is just responsible or is owning only a junior tranche, the other tranche have been sold out. So at times bank just own the junior tranche, or at there have been instances where in the back in 2008, even there was some bank who did not even own the junior tranche. They sold out it completely, even no responsibility. So why a commercial bank would like to own a junior tranche, right? So it is just to show or give a message to the underwriter or the various investors in the market, like when I'm going to carry on with a junior tranche, so it gives sort of an indication to the other investor there is no risk. Risk is largely with the bank only. Bank is keeping the junior tranche with them, and they are selling the high quality asset or high quality securitized asset to the investors. So that is what this process is all about. But this right now, the process that we talked about is from the mortgage backed security, because the securities are coming from the pooled asset of mortgages only. But the same can be done for the other kind of asset. It can be personal loan or automobile loan or student in the education loan and various other kind loan against property. All these loans can also be clubbed together in a very similar manner as we just discussed this process. So, and those securities can also be sold out to the investors in the market. So those would be called asset-backed securities. Instead of calling them mortgage-backed securities, they would be called then asset-backed security. And it can also be your, it can also has your bonds and shares and all. Those can also be part of this asset-backed security. So that is how these two different securities that we call, one is your mortgage-backed security, and another is your asset-backed securities actually securitize with the process of financial engineering, wherein your loans, which can be your home loans on the back of property or in the other form, are actually converted into securities and sold out to investors. So this process is called securitization, and this was quite popular back in 2008. In fact, it is popular today also. It is not popular today, but this is how a lot of securities were sold out to the investors. But it is not risk free. It is also has got risk if the securities which are being sold out to investors have a regular cash flow from the payment which is being done by your you know the borrowers who have bought those mortgages. If they stop making those payments, then you can realize the value of those securities which are issued in the market will start losing its value, right? So that's the risk it has got.
But
Okay,
sir, but
yeah.
sir, if banks are holding these junior tranches, so they must be getting higher interest rates, na? Since if you are moving to junior tranches, the interest rate must be high.
Yeah, so they no, so, yeah, absolutely. You're saying the loans which are issued, so they are going to receive higher interest because if they are giving a loan to an individual or to an entity who is higher, as in the who is risky, then the interest rate would be changed for them, right? So they are going to receive higher interest rate for sure. So the interest rate would be proportionate to the risk attached to the security. So the junior tranche will be having less interest rate. Mezzanine would be a little higher than the junior one, and junior tranche would be having the more interest rate compared to the remaining two, because safety is more on the senior tranche. So therefore, the interest rate would be less, as we know. Given as we discussed, treasury bonds have the highest safety in terms of or highest security, you can say. So therefore, the interest rate given by T-bills or government securities are less. Similar, the same thing goes with these securities also, which are securitized in nature. Okay.
Amit, is it the same as the cover one, which is means now is very popular, like NBFCs are doing such things? like many investors which are means financing two-wheeler loans.
Mhm.
So they are means collecting all the loans and they issued one bond which is called cover bond to the public, which is generally 10 to 11% rate of interest on that. Is it the same as the cover bond or
Yeah,
both are different?
covered bond is made out of securitized process only. The only thing is when you say covered bond, right? So covered bond means the risk would not be with the as in there would be a party who would be covering the risk. So the risk would be covered by the bank itself only. When you say
Okay.
covered bond, so risk will sit with the bond as in the bank only. But here you see the risk has gone to the investor directly. So if the investor themselves are responsible for the bond, so bank is not because bank just offloaded it to the underwriter. Underwriter sold it to the investors outside. Now the risk, where the risk is with the investor. So this is what happened back in 2008. You remember Lehman Brothers had to
Yes, yes.
make loss, right? So because they were owning a lot of mortgage-backed securities and asset-backed securities also. So even they were issued by one bank out here only, but who were bearing the pain? Pain was borne by the Lehman Brothers who had bought here in the end. So, but covered bond is more, it is a securitized product only, the covered bond. But the only difference in covered bond is the safety thing is managed by the bank itself. So bank would be responsible for the risk. They are going to be ensuring the payment goes out to the investors regularly. So even if the borrower of the loan, like you have taken an auto loan,
Yes.
right? You default. So you default does not mean that if I am the buyer of the security, I still need to get the interest payment. So bank has to ensure the payment goes out to the investor. So that is how you can say this is covered now. So someone is covering it even when the actual entity who is supposed to make that payment is not making payment. Bank is taking more liability and they are going ahead and going issuing the interest payment amount. So that's a good covered bond are the best bond you can say because they have got an extra layer of safety.
Okay, then it is a highly secure bond.
Yeah, you can say this is highly secured bond in a sense.
But means practically for the means retail investor
Yeah.
means
Hmm.
normal investor cannot invest in it because their lot size is very high. Means,
Yeah,
you
yeah,
have to invest
absolutely. The
much of the
bond,
money.
right? Due to for retail investors, largely these kind of bonds are not available. This is meant for the institutional investors only because they are auctioned in, and the auction process is such wherein the main player, the big player who are ready to invest, they are going to be participating in the entire deal. Retail investors are usually part of this government bond issuance and all, which RBI actually takes care of. So there the retail investors are given some stake, some say in the form of a stake and all. So, but otherwise, it is on these kind of covered bond and all. It is largely the institutional player who play the major role, and they are the one who are buying such kind in a big quantity and all. Right. So that is how it is. Okay. So uh, I hope because I talked about like in the beginning we talked about bond, then MBS and ABS. So MBS and ABS is what is made out of this process only. So the two securities I said we would be covering in the end. One was mortgage-backed security, another was asset-backed security. So MBS and ABS is made out of the same process that is called securitization. So right, so this is how it is. So when you say CDO, there is a term that is called credit debt obligation. Right? You would have heard this term. So CDO is again this security which is as in made after this process. That security is called CDO. CDO can be out of your mortgage-backed security, and CDO can be out of your asset-backed security also. Right. So another word you can say for this security is also called CDO, credit debt obligation. So this is how your entire securitization process happens. So mortgage-backed security is typically a securitization, an alternate liquid investment avenue giving exposure, raise capital, and enable them to issue loans in the market. So this we discussed. So one way with this you are able to raise capital. Bank need capital to raise more loan, so they cannot just be after issuing certain number of handful loans. They can't sit quiet because then the whole purpose is lost, right? So that is how it is. So bank need a constant flow of funds to issue more such loans, and by doing this securitization process they are able to raise capital, and then this enable them to issue more such loans in future, right? So with this we complete your fixed income, right? So as I said, like whatever we are doing, it is more from the conceptual point of view and from the point of view where you can explain these terms to the interviewer. And I'm very sure these are not difficult terms. You can definitely, if you just put in some little effort, you would be able to grasp grasp these terms and would be able to perform better in the interview. But you can't do it at the last moment. So if you just think after a couple of months or 2 3 months, you just at the end you start preparing it, then it will become a problem. So there is a make it a point for yourself that you will continue spend some time daily, maybe hour or so, even half an hour. If you spend daily, probably then also you would be able to cover it pretty easily, I'm sure. So that make it that way. It would be easier. Okay, so we done with the fixed income. Now we would be doing your, derivative and starting with forwards and futures. Any question before we start with this forwards and future? So a lot of videos in this presentation, especially in derivative, there are quite a lot, right? So you can maybe take out some time to go through these videos. I'm sure you would not be having time to look at all the videos at one go, but maybe you can take out some time to read it, to go and see these videos, maybe 1 or 2 videos every day. Like this one is for 19 minutes, right? So, and this is for 12 minutes. So you can accordingly decide like how much time you got. You can see these videos, and that way also some of the information, if something is not clear, you may also be able to clear the information, and that way you can also have more questions. Maybe in the beginning you don't have question because you're not sure like if this is something I should be asking, or you even don't have that question in the mind in the beginning itself. If you don't, right? So that way you can, or I would suggest even when you start with the chapter, you can do this. So that way it may give you more questions for your for a discussion, or for that way in the class. That is another way you can prepare. You can come ready, right? Okay, so these are the things we're going to cover in your derivative forward and future. An introduction, difference between OTC, ETD, factors influencing the value of derivative, forward contract, futures price determination, futures standardization, margin, future settlement. All these things we're going to cover, starting with the with some of the information about the market. So if you look at the size of the financial derivative market, you will see it is very big. It's huge. And if you look at the GDP size of the world and the bond market size and stock market size together, you will be very, as in, you will see this market is really big. It's a huge market, massive one. So 78 trillion is the size of the world GDP, right? That's the size of the world GDP. 100 trillion is the size of the stock and bond market together, and 700 trillion is this is the size of the global financial market. So it is quite massive one. So that's very clear with this thing. Okay, and then there is one quote from Warren Buffett. Derivatives are financial weapons of mass destructions carrying dangers that while now latent are potentially lethal. And maybe you have heard this quote earlier. So this quote kind of shares the view of Warren Buffett. He personally does not like derivatives much. Right? So if you look at this quote, this is what you might be able to make out as a Warren Buffett is not is not so is he's not one who is actually liking or who likes derivative much. So this is what is shown with this quote very clearly, right? Why is that? Any idea why he has said this quote and what is the reason behind it? If you know any story around it. Okay. So when you look at derivative market, right, there are various instruments available in the derivative segment. Futures and forward is something we're going to cover today, but other than this future and forward, there are options, there are swaps also. And out of these, when we talk about derivative, right? So let me just show you the Excel file first. So when you talk about derivative, right? What is a derivative as a meaning? You have forward, then I would say you have future, you have forward, you have options, and then you have swap, right? So when you talk about derivative, what is derivative as per your understanding? Anyone has ever heard about derivative earlier?
So I think it's a derived value from an asset
Yes,
class.
right. Very good. So derivative is it's a contract. It's a contract agreement between two parties, right? And this contract derives its value from the underlying asset or from the underlying product, I would say. Not necessarily it is a set, it can be any product or underlying agreement also, you can say that way. So it is a financial contract between two parties, and this financial contract is deriving its value from the underlying asset. And so the what underlying asset can be your stocks, right? Underlying asset can be your bond, and it can be interest rate, right? Underlying can be your interest rate, and underlying can be your foreign exchange FX.
So indexes can be.
Yes, yes, why not? Index. Underlying can be at times, weather can also be underlying. So anything and everything you can say can be underlying. Derivative has got this beauty wherein underlying product you can make even anything and everything. That is how this derivative is. So, but if you look at broadly, there are only four derivatives. Broadly, there are four derivatives, but these four are are mixed in such a way that the permutation combination of them are many. There's so many one, but we are largely focused on the these four so that we have an idea how derivative works. And then once we understand it, probably then we jump onto a bit more complex one, which is equity swap, right? And you have got your interest rate swap, you have got your currency swap, right? You have got your currency forward, and then so all these examples we would be doing in derivatives, so which you need to remember when you look at from the your as in from the interview point of view. So these are some of the examples which one needs to know, right? So give me 1 second. 1 second. Okay. So okay, now let's so what is future, what is forward, what is option? This is what we're going to do it quickly, and then we'll start. So future and forward, right? If we talk about these two products, these two products are quite same in nature. The difference between these two products is one is traded on exchange and another is traded on OTC market. So this is traded on exchange and this is traded on OTC market. However, the way these two work are same. So let us look at this example to understand how this future work. 1 second, let me show you this. 1 second. Okay, look at this example. Okay, so there is a contract happening between two parties. One is a buyer, another is a seller. So derivative definition is given there. Derivative financial contract whose values are derived from the values of underlying assets, right? That we discussed. So there is one party is a buyer, another is a seller, and they are doing a contract. Contract is at this rate, right? And what is the it is this contract is for rice, right? Asset given is rice there, and this contract is for future. So say for 90 days, future is for 90 days. That is the assumption that we are making here. So the time is 90 days. After settlement will happen at t equal to 90, and the rate is agreed today only. Okay, which is 120 rupees per kilo, and the asset in question is rice. So rice is being bought by one party and it is being sold by one party. So what is happening here? You are agreeing to the quantity of the asset that you're going to receive or pay or receive or deliver for, right? That's one. You are agreeing the price, at what price you are going to make that settle. Then you are also have the time when it is going to settle. So time we have taken is 90 days, right? So okay, so you can see very clearly buyer is there, seller is there. Buyer wants to buy, right, rice at this rate at t equal to 90. Okay, so why that buyer want to do that? What could be buyer's reason? Why the buyer is going for such a contract at t equal to 90? So at t before before 90 days, rather you can say that way. Before 90 days, you are going for such a contract. So that's the reason I've given a name future. Future means this contract is going to settle in future. It's not going to settle today. The contract is going to settle in future. So future is like 30 days, 60 days, 90 days. The future contracts have a maximum maturity of 90 days. The minimum can be 30 days, and then it can be for 60 days also, and it can go up to 90 days max. So maximum you can say can be of 90 days only. So in case of future contract, forward can have maturity up to 1 year. It can have 3 months, 6 months, 9 months, 12 months. So largely it is 1 month, but it can be customized and made more also. But largely the forward contract has been noticed. They are made for a year or so, but they can be customized. It is not necessarily it needs to be only 1 year or less, but it can be changed accordingly. So if you look at here, what is happening? Buyer has got this contract in the beginning, and why the buyer is buying it, because buyer has got this thing in his mind, maybe the price of the same asset rises in future. If the price rises in future, so the same quantity which is available at 120 rupees per kg today, that would be available at a higher cost. So if the same quantity, same as in, you can say the same asset, or in this case it is rice, if it is available 120 rupees per kilo today, if it becomes 150 per kilo, is this a risk to the buyer or is it not?
So obviously, it's a risk.
Right. So this is a risk, especially when you have got this asset for your own business need, then it is all the more risk. If you have got it for your own consumption, probably then also it is a risk. I'm not saying it's not a risk. It is a risk because your expenses are going to be increased. If you buy them at the time of your requirement, if that is when you buy, then you would have to spend more money to buy it. Similarly, look at from the point of view of business, the the business runner, right? So if there is a manufacturing unit which requires the constant supply of rice, right, and if they do not get rice at a fair value, then how difficult it would be for them to come up with the product which come up with a product which has got a fair value in the market, right? So in such a scenario, they would have to probably rise the cost, increase the cost of the product which they sell uh, to to cover the cost which they are going to bear in terms of the raw material cost which is increased, and therefore they will have to increase the cost of the final product which is going in the hands of the end users. So they can only control the cost of the product which is going to the end user only when they are able to buy the raw material at a right cost. So that's what the forward contract is helping various investors out there in the market. So investors can take position and they can ensure the risk. They can know, like, this is what the price is and this is the quantity, and they would be able to avail it in next 90 days or so. And by doing so, they are able to curtail their risk. They are able to manage their risk. If there is no such option available to them, then they will have to go in the market to buy all those things the same day. So, and then there could be two possibility wherein the price of rice goes to 150, just taking an extreme example. The price of rice goes to 150 per kg, that's one. Another, maybe then the price goes to 100 rupees per kg. So if it is 100 rupees per kg, then probably the buyer is happy, right? Because you are able to buy the same quantity which you were able to buy at one point in time at 120 rupees. Now you are able to avail the same thing at 100 rupees. So you are getting quite cheap, and that way your raw material cost is low and your margins are more. If you look at from the business owner point of view, your margins are quite high. Raw material is procured at a lower cost, and then you can make those products and get it available to your customers at the same rate at which you were selling it earlier, and now you are able to save quite a lot of money from the raw material that you are purchasing. So if so, there would be quite uncertainty or unpredictability in the price of your raw material if this deal is not done in the beginning. So this kind of a contract wherein one party reaches out to the other party and signs a contract for a future is called future contract. And the future is called a standardized contract. Why I'm saying standardized? Because these contracts happen on exchange. So exchange have already given certain guideline how you can do such contract. There needs to be, it needs to be in a certain lot size. Like if you want to buy, you want to buy a future contract for ICICI Bank as a stock. I'm taking an underlying stock. Then the lot size for the ICICI Bank is 1375. Right? So one lot has got 1375 shares. So if you go in the equity market, you can buy one share, you can buy 100 share, you can buy 1,000 shares. Like whichever number of shares you want to buy, you can buy from the equity market. However, if you want to take position in futures market, if you want to take ICICI Bank as an underlying asset for future that you are buying, you right. So you need to buy in the lot which is specified by the exchange. So exchange specify what would be the lot size of a particular asset when it is traded in futures. So that is what you would be able to take position into. You cannot say make it a 1,000 share in one lot. No, you can't do that. So lot size and certain rules which exchange has got needs to be followed. You can't change them. Okay. So hope this example you are clear what we're talking here. Anyone not clear? Want me to explain it again? Anyone? Okay, maybe you can take a minute, just try to understand what we have done here. Just take a minute and try to understand it. If not clear, do let me know. Then we'll talk about the other slides going then which are based on the other derivatives.
Please explain it one more time.
Okay. So right now we're talking of, as we know, there are four derivatives, right? One is future, then another is forward, then you have options, then you have swaps. These are the four broad one, and by using the permutation combination, we have made lot more. But at the moment, we are focusing on these four only to understand the basics. So see, this future contract which is appearing on the slide is wherein there is one buyer, one seller. They are doing this contract in future. So I'm taking time as before 90 days. So the reason buyer is doing this contract is because buyer does not want to have this uncertainty of buying something at a higher price than what it is available today. And there could be there could be many reasons for that, because it is a risk to the buyer. Buyer does not want to remain this uncertainty that then the total expense increases at the buyer side. So buyer want to ensure the expense does not goes up, right? The expense does not go up. And so by doing so, so the buyer goes into a contract with the seller wherein he agrees to buy. In this example, it is asset is rice, right? So buyer is buying rice at a rate of 120 per kilo, and assume 1000 is a quantity. So 1000 kilo is what he's buying at this rate. So if you calculate, you can make out what is the total contract value. Now, if the price of rice becomes 150, so buyer would be happy, right or wrong? If the price of the asset becomes 150 later, buyer is more than happy, because buyer knows he is going to pay only 120 rupees because as per the agreement they signed in the beginning. So they can buy the entire lot or entire future contract at the same rate, that is 120 rupees per kilo. 1000 kg of rice can be bought at the same rate, and buyer can even sell it in the open market later when the price becomes 150 per kilo. Or he can also use it, because if he requires a constant supply of constant supply of rice for his manufacturing unit, if he's a business owner or something, then probably he would not be selling it. He has made it for a business requirement, right? So he would keep that requirement with him, and for the production of the products which is making on the back of the rice, right? So that's another one thing. But if he is just a speculator who just making this gas, wherein he a speculator has got this gut feeling or idea that the price value of asset will increase over time, and therefore it is best time to buy it and later sell it. That could be another reason for that, right? Speculators also participate in derivative market, not in derivative market, in every market for that matter, right? So speculators are there doing this kind of a business wherein they're buying at cheap and selling it at a higher price. That could be that would be beneficial for their from their point of view. So it may turn out to be that way. It may not turn out to be that way. There might be a situation wherein they are not able to make profit and they incur losses. That could be a different matter altogether. But at the moment, we're taking first scenario wherein the price becomes 150. So if price becomes 150, buyer is happy because buyer knows he has done a good deal back in as in t equal to 90, before t equal to 90, right? Same is when the seller is able to the price goes down, which is 100 rupees, seller would be happy that he has done a good deal, because if price becomes 100 rupees per kilo later at t equal to 90, seller would think he did a good job by signing this kind of a contract in the beginning, because now the price has gone down, and he would have incurred losses if he would have not done this kind of a contract earlier with the buyer. So it goes from a different this is from two different point of view, buyer and seller. So one party has to bear the loss, one party would be in profit at t equal to 90 for sure. And this kind of a contract are termed as future contract, because this deal is happening in future, but happening today in future. Deal is happening today, so contract is being signed today. Everything is agreed today, but the settlement will take place in future. That is at t equal to 90, as an example we have taken. T means T stands for trade date. T, when I said t equal to 90, that means t equal to trade date. So t after, when it comes t plus 90, I would say. So t plus 90 means after 90 days, this is what will happen. Settlement will take place, right? Clear? Any doubt here?
Clear, sir.
Okay. So this we have covered. So why he said this is a mass destruction? Because the couple of derivative, like if you might don't know whether you heard this particular name, that is called credit default swap. We'll talk about this one later, but not at the moment. So if you know about this contract, that is credit default swap, you would have known this is a mass destructive in a sense. There, this can be traded by parties who have nothing to do with the agreement they are signing, but they are taking just for the purpose of making money. And
Yes, sir. Michael Burry did it in 2008. No?
yes, 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 yes. So, so there are many player who just take speculative position on various companies and all, and by doing so, they are kind of predicting this is how it will happen, and they are able to make a lot of money on CDS. So we'll talk about CDS. Don't worry about it. As of I'm just mentioning why he has said it mass destructive. He primarily broadly said it for this particular contract, not for every entire market. This particular contract that is called CDS, that stands for credit default swap, and this is being taken when you want to kind of secure your risk against the loan that you have given to another party. So that is when this particular product is availed. So we'll talk about this later more. So that is when this particular statement is more attached to that derivative instrument. Okay. Financial investment, a risky business. Risk is constant companion for all participants of the financial market. When participants deal with financial instruments, they face a risk of financial loss owing to fluctuation in the prices, right? So this is common to derivative market also. which is common there in fixed income and your equity market also. Same is the case with derivative market over. So the idea of having derivative in the beginning was to mitigate the risk, but now derivative is being is used for speculation also. There are players who do a lot of speculation and even does trading in derivative.
Yes, sir.
Okay,
Yes, sir. I used to do, but now margin rule is so that we need much fun.
okay, okay. So as a
On Monday,
future,
I did, since the market was very high at that point of time. So I bought an option of 33,000
okay,
C. So
okay,
it
Nifty.
turned out to be very well, sir. So I bought it at 220, sold it at 1,000.
Oh, that's
So
great. That's
it
great.
turned out to be great.
Yeah. So yeah, options are really good, and you can play smart when you have news and all. So that is the right time. You can also do the option trading in stocks and all. So the Nifty, I guess this one that you're telling is a Nifty one, right? Nifty or Nifty Bank?
Bank Nifty, sir.
Bank Nifty. Okay.
And this
So
kind of volatility only Bank Nifty can give, you know.
yes, yes, yes. Bank Nifty have more volatility compared to any as a Nifty. So Bank Nifty has a more options of making money.
Yeah.
So that's right. So yeah. And what about others? Anyone trading in female? And there is no female doing trading. How many are there? Rashi is there. Rashi does trading or no? Rashi, Shreya, Shreya, are you new to the class?
Yes, sir, I'm here.
Okay. Is this the first class, right?
No, sir, it's my fourth class.
No, no, Shreya Arora. I can see one name, Shreya
Oh,
Arora.
okay, okay, yeah.
So I'm not sure if you are the first. Is this the first class for you? Okay, no worries. I'm not. I guess you are mute if in case you're speaking. Okay, fine, no worries. So options and so be it any derivative, you talk about options, you talk about futures. Forward is so future is more on exchange, and when you talk about forward, the same example you can take it for forward also, the one that we just discussed here. This example can resonate with forward also, right? And forward and future have got the same thing. The only difference is forward happens in OTC. When I say OTC, that means the forward contract can be customized. So lot size and all other fine attributes of trade can be changed depending on the convenience and ease of two counterparties. So this is how counterparty want to do or sign the contract, so that contract can be structured that way. And it can be, so as I said, the contract usually the features are for 90 days, right? And it can be for 30 days, it can be for 60 days, and it can also be for 90 days. However, when you talk about from the forward point of view, right, forwards have got longer, even longer horizons. Maybe it can be up to 1 year. So right, that is, it is being customized. So it is customized based on the counterparty and party requirement. And this is why it is part of OTC market. However, if you look at this attributes of trade, this will remain, or the way the trade is done, this will remain same. There would be one party, and you see when you talk about forward and future, so the important thing is both the party are obligated to abide by their contract agreement. So if the party has agreed to buy, the party has to buy. If a party has agreed to sell, the party has to sell. So this is an obligation from both the sides. So this is what the forward and future has, right? Moving on. So the underlying asset of derivative can be all these. We already covered it. It can be basket of asset, index, even another derivative, such that cash flow of derivative depend upon value of underlying. So anything and everything can be there in derivative. So derivative is is a good thing at one side, and so at times risky also. So the good in a sense, you can take sort of a contract from the other party which can save you in difficult times. So that way it is a good contract wherein you are able to transfer your risk to the another party, and are you are doing good then. So that is the beauty of the derivative contract. Right. Okay, so look at this particular example, the example that we discussed, just to understand it again. Derivative are used for speculating and hedging the risk associated with fluctuating prices of assets. So see, there's one party which is a buyer, there is another party seller, right? I think the price of rice will go up in the future and I will make profit. So this is what the buyer is thinking, right? And I think the price of rice will go down in future and I will make a loss if I hold on to it. So when a contract is being signed, there has to be two opposite thoughts. Then only this kind of a contract can be signed. If you both the parties have got the same thought, then this contract can't be signed. Because unless you have a different opinion about the same thing which the other party has got, you would not be able to do the contract. That is how you're doing the contract. So like when you're buying an option at one as an option contract, as Nishan said, so you must have got this thought in the mind, the market is going to move upward. That is why you're buying that option contract, right? So the seller of the option has got a different opinion. Seller of the bank nifty has got an opinion, no, it is not going to move up that point. So, and this is how you are able to make money or lose money for that matter, because it is not always true. The market responds the very same way as you are thinking or speculating. So uh, there are scenarios wherein it goes up like you have thought, and there can be a scenario wherein it does not go as you have thought. Right. So this when you are just taking position for the profit, wherein you are kind of leveraging the market, so you would be called a speculator. However, the example that we discussed where you are running you're running a business, you are the running a manufacturing unit, you need a constant supply of rice. The example that we took here, right? So if you need this constant supply of rice every quarter on quarter, then you need to have this kind of a contract, and this contract will ensure a seamless supply of the of the asset that you are dealing into, and by doing so, you are able to curtail your risk, you are manage or mitigate your risk, right? So that is what this that is what you would do if you're doing this kind of contract just to mitigate your risk. You would be called a hedger. You're hedging your risk, right? So these two terms, speculate and hedge, are there. So if you are speculating, the price will go up. So you are acting as speculator. If you think the price may turn out to be bad and you want to cover your risk, you don't want to take more risk than what you can afford to take, right? So then you are covering your position, or you're covering your risk or losses, you can say. Then you are called hedger, right? So now coming to understanding derivative, how do you determine the value of underlying? If commodity cost 100 rupees, should the price be same if the same commodity were traded today but delivered by the seller after 3 months? If the price has to be different from the spot price, how should the price be determined? The price in future will be derived from the spot price. This explains the definition derivative. So how would you define, how do you derive the value of a derivative? Anyone?
Value will purely depend upon the market condition, based on, like, if we are, like, if we take into consideration
Yeah.
the uh, asset like grain, something like that. So it will depend upon the market condition, weather condition.
Yes. Right. Yeah, so you're saying one, it is on the spot price, right? The current value that will be the determinant of the future price, right? So because when you're taking a future contract, you're taking a contract for 90 days. As example that we took just now, the rice contract that you're signing with your counterparty, you're going to buy rice at uh, at time equal to 90 days. So when 90 days are over, then the settlement will happen. So while the contract is being signed, you're signing the contract on day one, right? So you are deciding a price for the contract. So how you deciding? One, you're looking at the spot price. So look at this price. The spot price is 100 rupees. So now you are going to see how this price is going to move. So there should be certain factors. The certain factors who are going to decide the price. So those factors are, just to show you on the Excel file. One, give me a second. So when you decide the spot, you look at uh, future pricing, right? So look at spot price. In this case, it is 100 rupees. Okay, and then you will look at what is the risk-free rate. Risk-free rate in market. Okay, so if you invest the same amount in market, in market which has got a risk-free rate. When I say risk-free rate, which is widely available, as in this rate is widely accepted in the market, and you can easily avail a return basis the rate which is the risk-free rate in the market. So that would be added in. So if it is 5% or assume 10%, just a round number I'm taking. So 10% of your 100, 110, right? So this is factored in. Then there is another cost, there is another concept called cost of carry, if you heard, cost of carry, or you can say storage cost. Can you see my Excel file, right?
Yes, sir.
Okay. Storage cost. Especially in case of rice, you would be having storage cost also. So that is your 10 rupees. So what is the future cost? Future value is 120 rupees in short. So just have given you as in how the future value, again, the spot price is something which is being decided by the market forces for demand and supply. How you deciding the spot price? It is demand and supply in the market, and your future price is something which you're going to pay in future, not right now. This future price that you, the future value or future price, whatever you want to call it, is is for time equal to 90 days, right? So this is how. So your future price, you can say, is a combination of two. One, uh, it is your risk-free rate plus plus cost of carry. These are two things which are there. And if you talk about from the point of view, your stocks and all our bonds, if they are paying dividend, then you have to minus the dividend from this thing. If you're going to receive any dividend in between when you have a contract, the dividend would be subtracted from this. So this becomes your future price of your contract that you're signing for this particular set that we're talking here. Okay. So hope it is clear. Any doubt here? Anything not clear? Or you want me to explain it again? Any, maybe in case.
The risk-free rate is market rate or spot
Yeah,
pricing is market rate.
no, the risk-free rate is the rate that you can easily, as in when you invest your money in the market. So this rate is kind of wherein you can freely avail this rate, and this rate is kind of wherein you don't have any risk, right? So the fixed income security where you can get this rate, right? I'm taken on the extreme side, 10% is can't be a risk-free rate for sure, but I'm just to round it up, I've taken 10%. But usually the risk-free rate is the one which is available without any risk, because you put your money, derivative has more risk compared to any fixed income product, right? Like your FD also, you can say fixed deposit. If you do a fixed deposit with the bank, they can offer you 6%, right? Or 5.5% or 6%, 6.5, depending upon the market situation. So that would be termed as risk-free rate because you can easily avail it. So you would always factor in, you will apply that interest rate on the cost, because this is the amount you're going to invest. 100 rupees is the investment that you're doing. If you are doing a 100 rupee investment, so you need to also apply some interest, because right now you are finding the future price of your investment. You're not finding, you're not discounting. You are actually uh, future value you're finding it, right? So future value you will find by applying some percentage of interest on the current value of the same product. So rice is available at 100 rupees at the moment, and with 10% the value changes to 110, and then you also have a cost of carry. So there is a cost of carrying, so that would also be added. So whoever is selling you, that would also be paying this cost of carry, right? Whoever would be selling it to you, that person has to bear the cost of carrying. So that 10 rupees, who's going to bear that cost? It is you, because you're going to buy it now. You are buying today, but you are not buying today from the market. You are actually buying at P equal to 90, but contract you signed today. So if you go sign contract today, you are responsible for the cost from today onward. So that is what it means. So it has got two factors into it. One, you can say risk-free rate plus the cost of carrying. And if you are also thinking of a financial, as an financial product like stock or bond, so stock and bond also give dividend and coupon. So in that case, dividend coupon would be subtracted from this pricing of futures, right? So that's it from the pure pricing point of view. But the determinant, you can say, as in the, if you look at from what are the forces which are determining the price, is it is the supply and demand. It is coming from the spot price only. If spot price is the determinant, if spot price changes, then your future price will also changes. So let's suppose it becomes 80 rupees. So for sure, this price will differently. This won't be 120. 10% of 88, and then the cost of carrying is 10 rupees. So that means your 98 would be the future price. So it will change. So it is coming from your spot price only. Any other question, guys? Good. Okay, so let us take a break now, because it is 2 now, more than 2. So let's take a 25-minute break. Let's begin at 2:30. Okay. Okay, guys. So I hope everyone is back. All right. Okay. So we understood about the pricing of derivative, right? So how the derivatives are priced. This is what we discussed just now. Any questions on that, or this, we should good to move on? Okay. Okay. So again, consider this particular thing. Underlying asset is rise and spot price is 100, right? Price of the contract is 40 per kilo or rupees 200 per kilo, right? So there is two things given there. Buyer wants to trade today, agree on the price, but would like to pay it at later date. Seller would like to agree and lock the price, but deliver the commodity at a late. Yeah,
The screen is not visible.
my screen is not. Oh, 1 second. Okay, so this one, I hope now it is visible.
Yes, sir.
So in such a scenario, so buyer wants to trade today, agree on the price, but today, but would like to pay at a later date. Seller, this is what is happening in future contract, right? So you are agreeing, you are doing this contract today, but the settlement of the asset that is being agreed in the contract will take place in future. Similarly, seller is also agreeing and lock the price, but deliver the commodity at a later date. So that's what you are doing in this contract. So when you go into, as in the parties go into trade, so one party agree to buy, another party agrees to sell, and the contract price and quantity and the settlement date, all these three things have been decided in the beginning only, but it will take place at the day of settlement in future. Since the seller would be incurring additional cost for storing the goods until delivery, would also be losing an opportunity of using considerable, he will have to be compensated for this by making the buyer pay additional amount. So we discussed about cost of carrying, cost of storing, storage cost, right? So this is the same thing that we are talking here. Since the seller would be incurring additional cost for storing the goods until the delivery, and that also will also be a losing an opportunity of using the consideration, he will have to be compensated. So that is how the pricing is taken into account. So when you are pricing the future contract, so you take into you take into account two things. One is the risk free rate which you can avail in the market, and another is your cost of carry. So these two things are included, and that is how the price is pricing for futures is done. Futures are traded on exchange, we know. Depending on the underlying asset on which derivatives was created, derivative can be either commodity derivative, financial derivative, and they can be traded on the stock exchange. They can be traded over the counter. So derivative, there are some derivative which are part of your over the counter market. There's some derivative which are part of exchange market. So if you talk about future, the four derivative that I listed in the Excel file: one future, another forward, another options, and another swap, right? So future is only in exchange. It is not in, it is not traded in OTC market. Then OTC market has got forward and future, as far as technicals are concerned, are same. The broad difference is one is traded on exchange, one is standardized, another is customized. So when I say standardized, that means you cannot change the attributes of the derivative contract which you're going to trade on future exchange, right? So that will remain as it is. Attribute means your, when you say how would be the lot size, the lot will be mentioned or mentioned by the exchange, and settlement will happen in monthly basis. So there would be a 1 month future, there would be 2 month future, there would be 3 month future. That is how that is decided by the exchange, and as individual who are taking position on those future contract are not going to are not allowed to make any changes to those contract. On the other hand, when you look at the forward contract, forward is same technically. The only thing is it is customized as per the customer requirement. So you are agreeing to the forward contract. The same example, you can take the one that we discussed for futures. But there you can change the time horizon. You can make it maybe 6 months, you can make it 9 months, and you can accordingly change the quantity. Quantity can be 5,000, rice can be 5,000 kg, that as per your convenience, right? So this is a large difference between forward and future, right? And then when you look at from the options point of view, option contract can be traded on, you know, on exchange, and options are also traded in OTC market. There are some no some complex or some complex or exotic options that we say, which are part of OTC derivative market. So we'll do those options into options presentation. At now we will focus on features, but just giving you the detail about kind of derivative that we have. Then swap is again, swap is one kind of a derivative which is part of OTC. It is traded in OTC market. Okay, so derivative contract is traded, not the underlying asset. So remember this thing when you talk about derivatives. So what is being traded? It is the contract that is being traded. Contract trades, not the asset. So asset will settle when the settlement date comes, not before that. Right? No ownership rights associated with the asset sold. There would be no ownership rights. So if you talk about the commodity which is there in the contract we discussed as an example, that commodity is not being sold. It is a contract being sold in the beginning. Quantity will be sold, but that will be on the settlement date, not before that. So that is how it is. It is not on day one, wherein when you signing a contract the quantity is sold. No, the quantity is not sold. So the asset is not sold. Asset remain as it is, as it was before, and you are just agreeing to the contract, right? A derivative contract is priced separately from the asset, right? So as we discussed, pricing of the contract is different from the asset price. Without putting up full cash value, derivative contracts can be settled delivery based or cash settled. So these 2 points you can understand. So let's without putting up full cash value. So any idea what does it mean? Without putting full cash value, and your contract can be physically settled and can also be cash settled. So let us take an example. So when you take a position in SBI contract, taken a SBI future contract, right? You can take any example. I'm just taking SBI as a stock underlying asset for this futures contract, and a lot size for SBI is lot size for SBI is 1500. One lot has got 1500 shares, and so you can if you look at the notional value of the contract, if spot price notional value, assuming the spot price is 400, right? So the notional value is your 400, right? So this is your 6 lakh rupees for one contract, right? Lot is 1500, and it is one lot that you're buying. You're long on this futures contracts. When I say long, that means you're buying it. These words, long, short. Long is used for buy, and short for the sell. So long futures contract, your one contract you're buying. At the moment the spot price is 400. So and your future price is, let's take a future price is future price is, it is is 405, right? And then your lot size notional value will be different. It would not be 6 lakh, it would be different. 405 multiply by 1500. So that this would be the notional value for futures contract, right? So how much you going to make upfront payment when you want to take position? Upfront upfront payment, right? So this upfront payment is like you're just going to make enough some 30% of this entire notional value. So this is a notional value you see here, and you're paying 30% of this value. So so that is your 1,82,000 is the payment that you make. That is also called the initial margin. The upfront payment that you're doing, that is termed as initial margin. You would have heard this term, right? Initial margin. So when you are doing contract, or when you buying the futures contract, so you need to make an initial margin payment to the to this broker, and that broker is actually paying that initial margin to exchange only. So exchange keeps this initial margin amount when you, so this is kind of a leverage you have. And though the positional, as in the notional value of the entire contract is 6,75,000, right? So but what amount you are paying in the beginning while you take a position in this contract, you're just paying 1,82,250, right? So this is what, without paying the full amount. When you look at this here, right, you can now probably if you look at here now, okay, this PPT, without putting up the full cash value, now you can probably relate it what we're talking here, without putting a full cash value, right? So while the contract value is 6 lakh something, how much value you are going to put, or going to uh, give to the exchange in order to take position in the SPI futures contract? Just going to give only 1,82,000, and with that you are able to make a position in the SPI contract. That's a good deal, right? So that way it is a deliver. It is kind of a leveraged position you can make. It is called a leverage, making a leverage position where you're not as in paying the entire money, right? So that is how this putting, without putting up the full cash value. Now when you look at this derivative contract can be delivery based or cash settled. So what does it mean actually? Any idea? Anyone has any clue? When you say derivative contract can be delivery based or cash settled, so how do you relate to this particular statement or term? If you have, anyone has heard this term before? No, no clue. Okay, no worries. So let us look at this with this the same example that we are discussing. So you, when you take a position in futures contract, you have an option, and the option is this: while you take a long position, short position, whatever position you want to take, you can either settle your contract in cash, or you can also settle, you can take a physical delivery of the underlying asset which you have agreed in the contract. So if you look at this particular example that we're talking here, we're talking about your long on the SPI future contract, right? And which has got a spot price of 400 rupees, and the future price is 405. The future fine price is 405. So you know, so your entire nominal amount for this one lot of contract, or even one lot of a contract is 6,75,000, while you're taking the position, initial margin you're giving is only 1,82,250, right? So if, and this contract is for your, as in 90 days 30 days contract, let me make it 30 days, not 90 days, let me make, it can be 30 days, it can be 60 days, it can be 90 days. So I'm making it 30 days contract, And when you pay this initial margin, so I take position today, and what is the when it would go, it would be the expiry. So I take it for June, right? So June uh, 24, right? So settlement will happen June 24th. Why June 24th? Because settlement always happens on the last Thursday of the month. So if you see, 24th is the last Thursday of June. It's the last Thursday. So in India, the settlement is always on last Thursday of the month. However, if you look at from the US point of view, the settlement always takes place on third Friday of the month. Third Friday, so that would be 18th, I would say. If you look at from the US standpoint, then it is 18th. If you look at from the Indian point of view, then you would the settlement of the future would happen every last Thursday, right? So on a monthly basis. So the last Thursday of the month. So 24th is the last Thursday when the settlement will take place.
Bank Nifty have weekly expiry, no? So is it also applicable in SBI?
Yes, yes. Yeah. You're saying weekly expiry?
No, Bank Nifty have weekly expiry, no?
Yes, yes. Bank Nifty and your Nifty both. Bank Nifty and Nifty both
Weekly
have weekly.
coming.
Yeah, both have weekly expiry. And when you have your stock as a underlying, then the expiry is always monthly,
Okay,
right?
okay. Whenever it means if the stock is also Bank Nifty included, then also it have monthly.
Yeah, then it will be monthly. Otherwise, you if you take position or index like Nifty, Bank Nifty or Nifty, right? Both can have weekly expiry. So weekly Thursday, right? Every Thursday of the week it expires, and you can also go for monthly expiry. You can also go for according to your ease and convenience. So if you want to take a monthly contract, right, not the weekly one, you can buy a Nifty monthly also. You can buy a weekly also. So options available for for customers. They can as per their ease and convenience they can take those different. But if you talk about stocks have only month as in one monthly, then 60 days, and then you are these 3 month contract that we have got, right? So that is how the for stock it is. For stocks we don't have weekly one. So we okay, just moving on. So you paid initial margin of 1 lakh into 2000 something. 24th June is the expiry date. Now we're talking about how can this be physically settled, right? Physically settled. So one is if you see on 24th June, which is the settlement date, 24th June, the price futures contract becomes 430 rupees, right? 430 rupees. So what at this you bought at the 405, and now the futures contract is 430. So what's the difference? So the price difference or the profit difference you can say is your this minus that, right? 25 rupees, and so total profit is your 25 multiplied by your 1500, 37,500 is your profit. Now you have two things you can do. One, you can do the cash settlement by taking an opposite position. Earlier you had buy position, you take a sell position. So these two, this trade will square off, right? You can square off your trade by taking an opposite position. Like you sell a trade and you sell it at 430. So you would be able to get the difference of 25 rupees. So that is a physical. This is a cash settlement. You have done a cash settlement. Okay, and physical settlement. Now coming to physical settlement. Physical settlement is when you know you do not take an opposite position. And if you do not take an opposite position, what will happen? Your position will remain open. And if your position remain opens, so that basically means you are telling the exchange that you want to take a physical settlement of the shares or the underlying asset. So in that case, you would have to keep the equivalent amount in your trading account. So you only put 1,82,000 in the beginning as the initial margin, but now on the physical on 24th June, you want to do a physical settlement, and if you want to do the physical settlement, you would have to pay the remaining amount, and you can take the physical settlement. So you add in this minus this in your account, as in you add this much money in your trading account, and you would be able to take a physical settlement. That means you would be able to take 1,500 shares of SBI, right? So is this clear or is this not clear? Something not clear or something clear? Cash, because we discussed two things. One is cash settle, another is physical settlement. So cash settlement, anyone not clear? Or is this fine?
So does the brokers in India provide these kind of physical settlements?
Yes, in India they provide. In fact, they started providing from 2018 onward, not before that. So before that, it was all your cash settlement, but now the physical settlement has been started in India also, and other market it was available for quite long time back also. In India, it's been a recent phenomena. After 2018 only they started doing it. So cash settlement is simple to understand. I don't think it's anything not clear there. Anyone not clear with the cash settlement, physical settlement, both are fine, clear, right? Okay. Just take a 2 minute or maybe a minute and a half to look at this Excel file and try to understand what we have done here. Anything not clear, do let me know. I can probably explain you again if in case you want me to explain it again. You I can just run you through again.
I mean, can you minimize the screen size so that we can see in one go all the transactions?
Okay, 1 second. Is it fine?
Yes, it's perfect. Thank you.
Sir, can you please repeat physical settlement?
Yeah, sure. So, okay. So physical settlement, like the example that we discuss here, you're taking a futures contract, right? And the mature, and the expiry is the 24th June. We're taking. It's a 1 month contract, and lot size for one lot is has got 1,500 share. A one lot 15 share notional value. So you will calculate what price you're buying this contract. So the spot price for the share, as in the SPI share, is trading in 400 rupees. So and the future contract is trading. I'm just assuming these value. I'm not done that as an interest rate and all those calculation. I'm not done. I'm just assuming the contract price, future price for this SPI is 405, while the spot price is 400. So you can calculate the contract price 400 multiply 1,500. So the total value comes out 6,75,500. Right now, while you take a position, you need not pay 6 lakh 7500. You do not need to pay that. That's the beauty of the derivative contract, right? So you go over the leverage thing as a leverage position you can make by paying only part payment. So the part payment comes out to be close to 30% is the initial margin when you want to take a position in futures contract. 30 to 35% depending upon the volatility of the stock and the situation. That is how this margin requirement is there. So you are making a payment of only 1,82,250 rupees as the initial payment, initial margin payment, and you take a position in futures contract. Now you see on 24th of June, the same futures contract which you bought at 405 on in the beginning now becomes 430. So you can clearly see you're making a profit of 25 rupees on this contract. So one, you have a cash settlement wherein you just take an opposite position and close your contract. You do the physical or you do the cash settlement, and you make a profit of 37,500 rupees. That's the one cash settlement we discussed. Physical settlement is wherein you bought one contract and that contract is not closed. That means you don't take an opposite position, and unless you take an opposite position, the contract is not going to be closed. And if you don't take an opposite position, you're basically sending a message, or this becomes a kind of a signal to the exchange. Even on the day of expiry, you do not take an opposite position, you don't close it. So the exchange takes it a message that you want to take physical delivery. And if you want to take a physical delivery, that means you need to have enough money available in the account, right? If you don't have enough money available and then you don't close your contract, you're going to incur penalties. Exchange incurs penalty if in case you don't close your account when okay. So that is how it is on the day of the settlement, that is 24th June, right? If in case you don't close your position and you don't even keep money, enough money, so then the one side you're telling exchange you want a physical settlement, on the other side you don't keep enough balance or enough money in your account. That basically means you are just not respecting the system there. If you don't respect the system which is there, so that means you're going to incur the penalties. So exchange will incur penalty that you, why did you keep position open when you did not have enough cash to take the delivery. So to take this physical delivery, you already put in this money in the beginning. This minus this was the total value minus the this value. You also need to put in extra 4,25,250 in account, and you keep this. I'm not taking the brokerage and all other things into account at the moment. I'm just purely taking the notional value into account, but you will also have to take into account the brokerage which the broker is charging. So assume there would be additional money to what this amount is. So close to 4,26,000 I can say is what you need to keep in order to take the physical delivery of 1,500 shares in your trading account or rather in demat account.
But sir, as far as I can see that we are getting 1,500 shares at a price of 405, but at this point the market is 430. So
Yes.
how come we are getting a 25 rupees discount?
No. You because as we discussed, you have done a contract. You done this contract in the beginning only, right? You're settling it on 24th June, but
Mm-hmm.
you signed this contract in the beginning of the month only. When you signed, the price was 400 fine. So your price is not going to be changed.
Okay, so they are obligated to pay us at 405.
Right. They are obligated because they have signed the contract in the beginning, and they said like they would be selling it at 405. You were the buyer for that contract, and there is an opposite side which you don't know on exchange who is the opposite side, but there is one contract open from the seller side also, right? And that was at 405. So that particular seller has to obligate the obligation which he signed in the beginning. So no matter what the price is there in the market on the day of settlement, if it is 430 also, then also they bound to sell the contract at 405, which is your value. So you're going to have only that much cash in your account in order to take the physical physical settlement. You need not to cover it with 430, because that's your profit actually. So that is how it is done. Physical settlement is done.
So this could be a great strategy, na? If we are expecting a
Yeah,
higher return on a share, and we on a 1 month prior we buy this kind of a contract, we entered into this kind of contract. So uh, this would for example, if we take SBI, so
mm,
if we buy at 300 and its price turned out to be 400 after 1 month, so
yeah.
after 1 month we will having 100 rupees profit per share, na?
Yeah, right, absolutely. But the important thing is like today, the spot price, because the driver to this contract price, the futures value, when you say 405, is actually coming from 400 only. So this price is actually based on the spot price. So if the spot price is 450 today, right? So this would be somewhere 455. Getting the point what I'm saying? So spot price means this SBI share price is whatever the share price. So you would be finding the future price somewhere above the spot price, largely on the upside. So if it is 300, then you can probably buy it at 305 or something, or 304 something, right? But if it is spot price itself is on the higher side, then your future price will also be higher, and that is how it will continue. It is a good strategy. People, what people do, I'll tell you. People kind of they uh, there is another as in people when they find the stock is going to be above, right? So they take this position. At the same time, they buy one put option, right? So you think the SBI is
Yeah,
going.
for undue risk, huh? For to cover undue risk, huh? It's
Right, right. So the smart people, they do it with different strategies. So they take position. They are quite sure that the space is going to go up because they have given results and all good results and all this, right? So they're quite optimistic it is to go up only. But at the same time, never know. You can't be 100% sure about anything that you do. So in the stock market or in the derivative market for that matter. So you need to be a bit cautious about on the downside risk also. So that way they at times take a maybe put also, if not very not at the same moment, maybe 10 points behind the number at which they're buying it, 10 or 15 points, so that can buy the put also at the right rate or cheap rate, and they make money that way. So this is a strategy. It's a future is a future and option go hand in hand. So अभी तो हमने future ही किया है, but when we do option also, then actually this becomes quite a big as a weapon to work in derivative market. Future and option. That's the reason you say future and option as a word goes together, right? We say future and option. We don't say only future. We say future and option, because future and option market work together, and people especially use these sort of strategies or these sort of ways to make money. Okay. Any question as of now? Hope it is clear. Anything not clear, you can let me know. Okay. Let me move on. 1 second. Let me share. Okay, so this is done without putting a full cash value. Understood what that meant. Derivative contract can be delivery based or cash settle. This we have done, right? So why derivatives? For speculation or hedging? Either you're doing it for a speculation or you're doing for hedging. Hedging and speculation, both the example we have already covered. So the example of one who is running a business, who is a business owner. So a person need constant supply of wheat or rice for that matter. So they are going to do these regular ongoing contract with the parties available there, so that they have a constant supply of the raw material, and they're dependent on the raw material to make those products. So and that particular kind of an example go for hedgers. Speculators are all those who are just taking position with the hope it is going to go this way. So they are all speculators, right? Okay, so derivatives, this definition is there. Derivatives are used for speculation investing. Some participants expect the market to move as per their expectation, and they take this risk in anticipation of greater rewards. There are participants who expect market to do a flip side on them and therefore take a passive view of derivatives. They use derivatives to mitigate the same risk which speculators take to make profit. Right, so that is how it is. Value of contract we have largely done. Value of derivative contract is influenced by several factors. Market trends affect the value of derivative markets. The market phenomena is the one which is deriving the value. Other than that, we discuss risk-free rate plus your cost of carrying is there for pricing the derivative. Futures derivative, will say futures derivative is priced that way. Other than this is your how the market is behaving and responding is one actually creating volatility on in the asset values. So the spot price decreases, spot price changes, then your future price will definitely change, right? So so that is how your in case of option, there is one more thing, that is not time decay, and many more things in case of option, because if you look at from the option point of view, there are Greeks which are there to value the options. So we'll discuss about Greeks later, not today. So from the future point of view, this is enough. Role of speculator, you understand what do speculators do. I guess need not emphasize again because we've discussed it. Okay, so bullish view, bearish view. This is expecting the spot price to go up. That's the bullish view. That's the term used in investment banking. I'm bullish. Bullish means I'm expecting the share price to move up. Bearish, expecting the share price to or stock price to move down. So that is how you say bearish view or bullish view, right? Sorry. Okay. So importance of speculators. So the speculators have their own importance in the market, because without the speculator, the kind of a movement that we see in the market is not possible. So everything, if happens on a need based, then there would not be that level of movement in the market, and if that level of movement is not there, maybe the price discovery does not happen in a nice manner. So the price discovery, a better price discovery is possible in exchange market, largely because of volatility, or because of the high volume available in the market, and that actually because of the speculator. Speculators are doing doing trades for profit making, and that uh, especially makes you at times buy at cheaper rate, buy at higher rate also. That depends upon situation to situation, how those traders or speculators are placed on those stocks and commodities available in the financial market. If they're bullish, then sure the price would be higher. If they are bearish on certain assets, then the price would be lower also. So that is how the price discovery is possible in the exchange market, right? So price discovery, I hope you understand what when I say price discovery, that means you are able to find a right price for the asset. That basically means the price discovery. Okay. The price of the underlying will increase, long position, and the price of the underlying will decrease, quick check, short position. So when you take a long position, long means buy. So you are beneficial, you are in a profitable situation when the position which you have bought, which you are long on, actually moves upwards. So if it goes on the upward direction, then you as a long position holder is in profit. Similarly, for the short position holder, you are in profit when the position goes downwards. That means at the downside, if it is going, then it is a beneficial position for the short position holder. Okay, anyone who buys a short security with the expectation of favorable price change is speculators, right? So again, a definition for speculator. Just read it out. Anything not clear, I'm very sure it's very simple to understand. So I'm not going to repeat it because I already covered it. Fine. Okay to understand. Move. Good to move on.
Yes, sir.
Okay, great. Okay, so the role of hedges. Now we have already covered it already in the previous discussion. So again, this is simple to understand. Nothing such more to add on to it. What I've added already is covered. They can easily transfer risk to counterparty who has an opposite need or view about the market. The main focus is their core business. Their aim is to evade the risk of loss due to the price fluctuation in the market of the underlying, right? So same example you can again imagine the wherein the manufacturer is buying rice at a decided price in the beginning of the contract. So that's an example of hedger hedge. Now look at this particular example of hedging. So there is a exporter, right? Exporter is exporting to the US counterpart, and the garment exporter, right? And what is the value he's getting in return? So he is to receive $100,000 in return, and that is going to be coming to him after 3 months. You can see the time here, 3 months. Right now, the spot price is USD oblique INR is rupees 70. So one USD is equivalent to how much? 70, right? So as a exporter, you would be having these factors or these things in your mind. Rupee is going to appreciate to rupees $1 to 65 in 3 months. So what will happen if rupee becomes $1 to 65? What will happen to the exporter? Would it be good for exporter or bad for exporter?
They bad for exporter as he is going to receive a less amount of Indian currency.
Uh, I did not get it. If you can just repeat what you said.
Yes, means in the first case, the exporter will get exchange of $1 70 rupees. But
Uh-huh.
if it is appreciated to 65, he will get 65 only, and against of $1. So it will be loss for the exporter.
Okay, it is a loss, right? So if it
Yes.
becomes $1 equal to 65, so that is going to be loss to the exporter, right? Everyone agrees.
Yes.
Anyone has a different view, or the same, right? Okay, so that's true. If it becomes $1 to 65, then it is it is a loss to the exporter, right? And if it becomes $1 to 75, then it is a profit to the exporter. So this exporter is into core business of garments, and probably having a loss of 5 lakh rupees, because if the dollar becomes 65, right? So there is going to be loss of how much? You can see the value would be 65 lakh rupees and 70 lakh rupees. So that means that total difference is 5 lakh rupees. So with dollar moving down to 65 is actually going to give a loss of 5 lakh rupees to the exporter. So maybe the exporter is not ready to bear a loss of this kind. So what an exporter can do here, exporter can reach out to his bank, investment bank or swap dealers who are available in derivative market. An exporter can say, I need a contract which can give me $1 equal to 70 rupees. So you can see here this portion of the slide. Here you see there is exporter negotiating with counterparty. Counterparty you can take a bank or a dealers available in the derivative market. So he is saying I need a contract which can give me $1 to 70 rupees. And um, by having this contract, he can be sure, he can be as an rest assured, like he is going to receive 70 lakh rupees after receiving this $100,000 from counterparty, no matter what happens to the currency fluctuation in the market. But because he has got this contract from the counterparty, so the price or the money which he would be able to get at the end would be the same money which he is expecting today at time t equal to 0 or t equal to 1, whatever you want to call it. So when in the beginning he is expecting, in the beginning this is the rate, right? This is the rate. So he's expecting 70 lakh rupees in return against this contract which he has signed with the US counterpart. However, if this price fluctuates, then there can be a problem. So now with this contract which he is doing with the counterparty, which is a bank, he is very sure there would not be any variation in the final value, that would be money that would be coming in his hand, and by that he would be able to cover, he would be able to manage his risk. So this contract he does with the bank, and the bank is able to is going to obligate this contract. So bank has to obligate the contract. They're going to give him dollar with the same rate which they have signed in the contract. So if the dollar goes up, right? If dollar goes up, then bank is going to make profit, and if dollar goes down, the bank is going to make loss also. But bank do this transaction in such a manner that they are able to they're able to cover their risk. Any idea how bank covers risk in this situation? Any clue how bank is giving this contract to the exporter? Because bank is bank doing this trade without covering its risk, or how bank is doing this risk, this particular trade?
Maybe sir ensuring the some
Yeah,
insurance.
right. So generally, this kind of just to give you one example, like how bank can do this contract. So bank can also do in such a manner so that they can cover their risk. So what they will do, they will go in the money market segment, right? And they know how much money the exporter or his client requires. So money required by the client is 70 lakh rupees, right? With the contract. With the contract that he has done. 17 lakh rupees at time equal to 90 days or time equal to 3 months, you can say. So what the bank will do, bank will borrow this 70 lakh rupees from the money market, right? And then the other hand, the same very same day they will lend, right? They will lend 70 lakh rupees to another party. So one hand they are borrowing, and on the other hand they would be lending this money 70 lakh rupees to other party for time equal to 3 months. So this way bank is able to mitigate its risk, but bank would be in profit if dollar becomes 75, because as per the agreement you are going to receive money only with this rate. You are going to receive money at the same rate. You are not going to receive an extra money. If the dollar becomes 75, the 5 lakh profit which is in the pockets of the bank only, right? So just to show you here in the Excel file, you can just look at. So $1 is equal to 70 rupees. Okay. So and the deal amount is equal to dollar 100,000. Fine. So the total export value is 70, right? So this is the total export value. 70 lakh rupees is what exporter is going to receive if he receives the same rate, that is $1 equal to 70 rupees. That is the money he's going to receive. So the exporter is uh, is worried about rate changing. In fact, he's worried about if the local currency, that's the Indian currency, strengthens. That is what he's worried about. So if the $1 $1 becomes 65 or anything, any other number for that matter. It is exporter exporter going to bear loss, right? That is 5 lakh rupees, you can say, right? That is the loss. So exporter goes to bank for forward deal, forward FX deal, right? The quote is the quote he is asking is $1 equal to 70. This is the quote which he is asking, $1 equal to 70 with his bank. Bank can deny the quote. Bank can say no, we can't offer. We can offer only $1 equal to this and this. So it depends upon bank only. If bank is comfortable to offer the same quote or not. So if bank is comfortable, then it is fine. If bank is not comfortable, then bank will change the quote value. So they can say I can offer you $1 equal to 69.5, all that. So that is how they can say. So bank, what bank does? Bank borrows. Usually, if you look at in the background, bank borrows money, the money which they are obligated, money from money market. Money market. Why money market? If the money market is short term market, right? So they will take 70 lakh rupees. That money they will take, and the bank lends this money to some other some other player, right? For t equal to time equal to 90 days or 3 months, you can say, right? So here the bank is going to pay interest, and here bank is going to receive interest. So you can see bank is able to mitigate its risk, right? Clear? Hope this is clear. It's easy to understand, I guess. Anything not clear here? Okay. So let us move on then.
In this bank also charges some commission to the exporter also.
Yes, yes,
So it will be one kind of profit to him. So that if there is risk, bank can
yes.
minimize the risk.
Bank will take some profit also. No,
Yes.
some margin. You can say some margin would be there. In a sense,
Yes.
that is a direct profit. You can say so instead of giving $1 equal to 70, they can offer. Let's make it 69.5025, right? So this difference is a bank's profit, wherein brokerage is also involved, and they're also giving sort of covering their risk also with that. So that
Yes,
is,
in bank in every day there will be means rate change. Like bill buying rate is different, bill selling rate is different.
yes,
So every day there is fixed rate.
yeah. So like the in FX we saw bid and ask rate is there. So that bid and ask will always play there, and that there would be some difference, and that difference is the bank's benefit. But bank, that is that is a one profit or one way of making profit. Another way of making profit is if your this deal that you have done with bank, wherein $1 equal to 70 rupees deal you've done. So if it goes to $1 equal to 65, that is when it is a problematic situation, right? Because but it is not a problematic for bank. Bank is already done another deal to manage that risk. So if you look at this particular deal which has been done by the bank, this is actually for mitigating the risk only, right? They are bound to
Yes.
pay 70 lakh rupees. They have already managed 70 lakh rupees on day one only, and they're paying interest on this deal. At the same time, they're receiving interest also because they have lent money the very same day because they don't have any use of this money today. They need this money at t equal to 90, right, for this deal that they have done today with the customer. So they are earning interest here and they're paying interest here. So that interest would be managed here, right? So that is taken. You can say this interest is offset by this interest largely, or even if there is some sort of maybe they are earning more by by lending this money to their customer. That is also possible. So they might be earning some interest also on this money. And at the same time, if a dollar becomes 75, then see, then you can imagine what is happening. If
Yeah,
dollar becomes
direct 5 rupees profit to bank.
yes, yeah, the 5 lakh rupees is coming directly in the account of bank without any effort,
Mhm.
right? So that is also one way of earning money. So here also the excess money which comes because now the exporter can't say no, I would the excess money I'll keep. No, you can't keep excess money because you have already done a deal, right? When you've done a deal,
Mhm.
that means you're going to be paid only the same money. The hedge has its own risk and pros and also own risk and benefits. So benefit is your you know what you're going to receive. This is already predetermined, pre-decided. But the risk, you can say, if it goes in your favor, then that favor is not going to come to you. So that is gone from your side. So that is what happens in case of such deals which happen, which hedge deal which take place. Okay. Okay, let me just come to the screen slides. Okay, so just look at this example. Just take a minute and read through what will happen in this. We have already covered it. We have already covered it. Just try to look at from your point of view what how a position would be made so that this situation can be addressed accordingly. Okay, so the first is portfolio manager is worried about the fall in market value of a particular security, which he wants to hold for next 3 months. How can he mitigate the risk? And the second is input cost of instruction company. Company is worried about the increasing cost of concrete steel rods. These steel rods are also traded on futures market. How can company eliminate the effect of price raise in their project? And the final one is exporter of garment to US is expected to receive this 100,000 USD. This we have already done the same example. Okay, so if you look at from the futures market point of view, in the first case scenario, where the portfolio manager is worried about having a fall in the market price of the position of security that you've taken. So what portfolio manager can do? Portfolio manager can short the security, right? Portfolio manager can short his security, and that way, if he shorts, so if the price goes down, he is covered. He is able to mitigate his risk. Short means you are selling your security today. So just to make you understand, so when we talk about short, right? So when you do a short, right? So how do you do it? So you can do future short. You can also do short and equities also possible, but it is only for a day. In future, the short can be done for the contract period. If it is 30 days, 60 days, or 90 days, accordingly, short is valid for those number of days which is there in the contract. So you can do 30 days short also, you can 60 days short also, and you can also do 90 days short. So that is the that's again a feature or characteristic of futures contract. So you believe as in the price of the security, which is right now trading 400 rupees. Let's take same example so that we are able to relate it easily. SPN share, fine. So this is 400 rupees is trading. You are worried like this can go down, and if it can go down, then you're going to incur loss, right? So what you can do, you short future, SPI future contract, short SPI future contract at 100, at 400. Okay, so you are now shorting the SPI futures contract 400. Why you're doing? Because you are worried the price of this future as a not the future, but the price of your SBI share can go down, and therefore to mitigate your risk, you are taking a short position. You're taking a short position. So if it goes down, then you need not worry because you are going to make profit on the short position. So when you short means you have sold at 400, right? This okay. And if price becomes 300 and price becomes your 300, just take an example. So what you would do, you will buy SPI and future contract at 300. So difference of 400, oh sorry, 100, 1,50,000. So on the position that you are holding in portfolio, you would be incurring a loss of 1,50,000. And on the futures contract, that is a short futures contract, you are making a money of 1,50,000. So net, you're not making any loss. Net, you're not making any loss. Clear this one, this example that we discussed. Any doubt here? Just take a minute, just look at this and just let me know if in case nothing if something is not clear.
Sir, but in this case, there is a loss of 1,50,000. So, how are we able
Yeah.
to mitigate the risk in this case?
In this case, this short position that you done because you know you have this fear in your mind, the position that you are holding in a portfolio, like this is given there in this shared in this PPT, right? So you are worried as a portfolio manager, you are worried about the fall in the market value of particular security which you want to hold for the next 3 months. So you are holding a security already in the portfolio, right? You are holding a security in the portfolio, and but you have this fear factor. You have a fear factor. Like if I hold this security and if it goes down, it falls down in the value, what will happen? So you have already we are taking this as a situation wherein you bought it now. You already taken this position that portfolio manager is talking about. So that means you have bought how many shares? 1500 shares you bought. At what rate you bought? 400 is the market rate, right? You already bought it and you are holding in a portfolio now. Now you are worried. What will happen if the share value goes down? So when we looked at this particular example, here you are making 1,50,000 profit. So the 1,50,000 loss that you are incurring on the share value that you are holding in the portfolio, you are able to make up that loss by doing this short of futures contract. The SPI short that you've done, with that you are able to make that loss up, and your loss is covered. So there is no profit, no loss. You can say your position is still the same, right? So the idea of doing short is to cover the position in your portfolio.
But not clear. Please
Not clear? Not clear. No worries. Let's understand again then. So you are a portfolio manager. How many shares you are buying? You're buying shares of SBI, 1,500 shares. Okay, now you bought it. Now you bought it. Now after buying this share, your mind is saying, if the value, at what rate you bought it? At 400. At 400. So what's the total investment? Total investment 1,500 into 6 lakh rupees, right? Now your mind is saying that if in case the share value falls, if the share value falls, you will have a loss in this position that you have made here as a portfolio manager. This position you made, right? Correct or not correct? So you start incurring loss here. But when, right? So you will be making loss on this particular position. Just look at this particular line, as in 40, row number 40. So you have bought 1,500 shares at 400 rupees. Total value is this. But if the value goes down, when I say value goes down, the price goes down. So it 400, it is 390, 380, 350, whatever you can call it. So if it is going down, that means you are making loss on this particular position, and this value will go down accordingly. Now, when you want to mitigate the risk, so what you're doing, you are shorting a futures contract. So when you shorting a futures contract, what does it mean? You're selling the shares, right? And one lot has how many shares? 1,500 shares, we know, right? So you are selling one lot. At what rate you selling? You're selling at 400. At this rate you're selling the contract. Now when it goes down, you buy at 300. So when you buy cheaper and sell higher, so you make profit, right? You were able to sell at the high at 400 rupees in the beginning, and when it goes down, you are able to buy it at what rate? 300. So what the loss that you're making on the shares that you're holding in the portfolio are able to cover with this contract, futures contract. So these two are different. These two different position you have. One, you have the futures contract position, right? Another, you have shares in the portfolio.
Yes,
So
sir. In case of future contract only, we are able to safeguard our money. Otherwise, we would have incurred a loss of somewhere around 1,50,000.
yes, yes, right. So if you don't take this position in the first place, so then you would have made a loss of 1,50,000 because of share going at 300. This is the assumption we are making. The share goes below to 300 rupees. So you would have made a loss of 1,50,000 if in case you don't make this particular short position on futures. Is it clear or not clear? Still not clear?
clear, sir.
Clear, right? So that is how these are two different positions you can say. One is the number of shares holding in the portfolio. Another is you are shorting the futures contract, and by shorting you are able to make money here, but you are losing money here. So that way your net you are no loss, no profit, you can say. Okay, 1 second. Okay, moving on to next slide then. This is simple. The second example, construction company is worried about the increasing cost. So you can take a long future, right? So that way you need not worry about the cost which is going to be which is going to increase in future. You're going to buy at the same rate at which you take a long future, right? So that how, and this one we have already done. So that it's it is complete now. So if you look at the hedger has a risk averse attitude. They do not want to take any risk. Speculators have a risk seeker. They want to take risk. So the hedgers actually transfer their risk to speculators. So in short, you can say if you look at the system as a whole, derivative market as a whole, then you will find the risk on the trades which are done in the market are not mitigated completely. Rather, a risk is transferred from one entity to another entity. So the entity or the party which is not ready to take on the risk attached to a trade, they would like to hedge their position, and there would be a player in the market who want to take on to the risk to make profit or whatever way they think about the market. So they would be accepting those trades. So that is how speculators play their role. Speculators are largely there to kind of they're there to take position the market, increase the volume, and that way they also able to hedge. They are able to help hedgers. More of trading volume is there available there because of speculators. Okay. Okay. So what is the types of derivative? One is exchange traded, other is over the counter, standardized contracts, market risk, private tailor-made contracts, market risk is counterparty. So if you look at over the counter trades, they're the private trade between two counterparty, and they are tailored made. Tailor made means made according to the ease of the party or the counterparty, right? They customized trade as we discussed in the beginning also. So that is why they call over the counter trade. Over the counter market gives this flexibility wherein you can customize trade for your counterparty. However, the exchange market does not give this flexibility or this leverage wherein you can customize as per your convenience. You will have to go as per the convenience of the exchange, whatever standardization which exchange has done. That is what you have to follow as an individual or the entity who's trading on exchange. So you can say, if the lot size is 1500 for SPI, you can't say I need only 1000 share. Make a lot for 1000. You can't do that. That is not possible. Similarly, if you say if the contract you can avail contract for 1 month, 2 months, 3 months, you can't say I need a contract for 6 months. No, it can't be possible in exchange market. It can be possible in the OTC market because OTC is all customized market. So that is how you can relate it. Standardized contract and market risk. What is market risk? Market risk we discussed earlier also. So it is a risk associated with the market. The change in interest rate, right? Any event which is happening in the market can cause disturbance in market. So it can be change of government. It can be the elections happening in the market, or budget day as an event that is also causes a lot of market risk or market volatility. You can say. So any risk or any event which is causing some fluctuation in the market, that can be called a market risk in a sense. Okay, let's move on. These are difference between the two market. Exchange market is a regulated market. Central clearing houses are there. Standard agreements are there. Guarantee of completion of operation area. No customization. Unregulated market is this is unregulated. No centrally clearing houses are there. Bilateral agreements are there. Customization is also possible. Okay, so these are differences between two markets. Fine. So
That is how one party would be negotiating deal with the other party. This is just an example of the OTC trade between UBS and Citi. Contract that enter in OTC market are known as bilateral agreements. So between two party, the contract is signed between two counterparties. Therefore, it is called bilateral agreement. So features of OTC derivative less regulated than exchange. No centralized trading place. Bilateral agreements. Customization and flexibility is there. An exchange traded derivative is a financial instrument that trades on regulated exchange and whose value is based on the value of another asset. Simply put, these are derivatives that are traded in a regulated fashion. So derivative as a meaning is same, be it your exchange traded derivative or OTC. The meaning for both, both kind of derivative happening in OTC or in the exchange market, definition would not be changing. It is only the way the contract are done that is change a little bit in two different markets. So these are some of the world exchanges that we're talking here. Korean Exchange, Euronext, CME Group, Chicago Board of Trade, NY, New York Mercantile Exchange. So these are few examples of exchanges. Okay, just for your information as such, I don't think there would be any question, but you need to know the few of the exchanges like London Stock Exchange, Nasdaq, NYSE. These are some few great big names. So exchange traded are futures and options, and over the counter are forward swaps. In addition to this, you can also add options in over the counter. Over the counter market has forward, options and swaps, all three. And your exchange market has only two, which is your futures and options. So these are the four options. These are the four derivative: futures, forward, options, and swaps. No definitive list of derivative products can also be merged to form a new derivative products. So as I said, there could be many permutation and combination of derivative contract by using all of these four. So that is how this can be multiple different kind of derivative contract by using these four. Leverage, we know what leverage is. Like the example I told you, when you want to take a you want to buy a future derivative for SPI, and you're not taking entire value, so you are just paying 1,82,000. It is a kind of leverage. The actual value is 6 lakh something, but you pay only 1,82,000. It is a kind of a leverage position you take. Okay. Now total value of the asset. So notional value is the leverage position. So contract size multiply the current spot price per unit becomes your notional value. So as in the contract value is called the notional value. Like in our case, what was the notional value? 405 was the price, contract price of the derivative, and 1500 was the contract size. So 1500 multiply 405 becomes the notional value of the contract, which you pay only when you settle. So day of settlement would be having any relevance, or this notional value would be having relevance on the day of settlement for physical settlement. And for cash settlement, it does not make much difference, because whatever difference you have with the agreed trade to the day when the asset of the contract is trading, that difference is primarily the cash settlement amount. So the cash settlement is just the difference between the two, and notional amount would become a settlement amount when you're going for a physical settlement. Right? Any question as of now? Okay, so for this probably I'll not want to just complete the further slide. We can stop here. Let me just take your attendance and let me know any questions you have. You can take here, and then remaining stuff we'll try to do in the next class, not now.
So when we are trading on an intraday purpose, so the stocks which we hold, they doesn't go on the any depository. So where does they stay?
As in, you're saying the shares that you hold in your account, that one you think?
Yeah, yes, sir.
So when you pledge or in which scenario you're saying they don't
If
go
we are
anywhere?
doing on an intraday basis, sir, so that's the amount in
Okay.
the trading account, now. So
Yes, yes, right, right. So yeah, intraday settlement is like if you settle on your own. So right, like you
Mhm.
buy a position in the morning, right, and you're going to take an opposite position before the close of market, right? So that
Yes.
means it no movement takes place, nothing happens. So it's a very clear signal to the market or the exchange, right? Nothing happened. You just did not. There is no movement going to happen. So movement only happen once the market closes and the position is open. So you're actually leveraging the the positions available in the market. So there would be people who would be taking physical delivery also. There would be people
Mhm.
who would be just buying and selling, buying and selling, buying and selling. And difference, whatever difference they get, they take it in the form of profit, right? However, so as long as there is no open position, so there is no movement of stock is going to happen. So you are just going to receive the money in your trading account, right? At the end of the day, in the form of cash, right? And stock movement will not happen. So though as such, nothing is happening, you can say. So there is trade, virtual trade is kind of, you can say, the is happening. So actual trade will only initiate at the day end. So if position is open, if position is not open, that means you did not uh, you did a trade, but that trade was sort of closed the very same way as you opened it. So that is what you are doing.
And sir, uh, in the starting of the session, you told that this derivative market is around $700 trillion market.
Yeah,
So, uh, is this a leverage amount which is
yeah.
making so
It is
unnatural?
it is the notional amount, not the leverage. As in the 6 lakh. When I say you are paying how much, 1,82,000. One notional value
The,
we are
the
talking.
rest of the amount is being paid by our broker, or is there any other element which you are missing?
No, no, the broker is not going to make any payment. It is so there is a concept of initial margin that we discussed, right? So when you're making this payment to when you're buying this contract, right? So you're making upfront payment, that is called initial margin,
Mhm.
and then your initial margin. So in the same chapter that did today, we have this how this initial margin work and how this profit and loss is calculated. So your profit and loss is calculated daily on a daily basis. So daily settlement happen in futures. That does not happen in options, because you're doing option, you would be knowing there is no daily settlement in options.
Mhm.
But in futures there is a daily settlement. So when I say daily settlement, so you bought a position, assuming just to 1 second, let me show you this Excel file. Where is that? Mm, so if you say you bought this at 405 something, right? We discussed this earlier. 405,
Mhm.
and on the day end it becomes 407.
Mhm.
So that means 2 rupees profit.
Mhm.
So your profit would be 2 into 1500. So 3000 rupees would be added as a ledger in your trading account. So now, as long as so this amount, this there is another number which is called maintenance margin. This is the initial margin we talked about. I did not talk about maintenance margin. We'll be talking about this, but just given you asked the question, telling you there is a maintenance margin account also
Mhm.
that says 90,000. Just telling you an example number. Okay. So if this loss which you are having, so it goes below 90,000. Right now, what amount you have in your account? 1,82,250.
182.
So if it goes below 90,000, then your broker will send a call to you, and the broker will tell you top up your account to this level. So broker cannot, and that call is not only from broker, it actually comes from the exchange directly, and broker is the medium who is actually calling you up and asking you to top up. If in case you don't top up, you say no, I am not going to top up. So what will happen? Your position would be squared up. Your position would be squared up at loss, and you would be gone. So remaining rest of the amount means amount below 90,000 would be there in your account. The rest of the loss would be booked by the broker from your account if in case you don't respect the call which broker sends to you. So that is how this maintenance margin plays a role. So maintenance margin is just to give an indication how much loss you can have in your on a contract. So if you can take a loss of up to 90,000, you're safe. You're not going to pay any additional amount to the broker. So as long as it is within the range of 90,000, the loss is within the range up to 90,000 is fine. If it goes even a 1 rupee down 90,000, then you need to top up the entire money. That means 9 plus 90, this entire 182,250 minus 90,000. So this is the amount you need to put into your maintenance in your initial margin account again. So that is how it will be. This amount you need to put in. So the moment it goes below 90,000. So just an example I'm telling you. Okay. Mm, okay. This is batch 42, right? Okay. Deepak is there.
Yes, sir.
Ajay is there.
Yes, sir.
Is there. Vashpet is there.
Yes, sir.
Okay, fine. Kanika is there, right?
Present, sir.
Okay. Rahul is there. Okay. Rahul is not there, I think. Okay, Rahul is absent today. No,
No,
Rahul
no,
is
no,
there, right?
sir. I'm there. Rahul.
Okay. Nishant is there, Rashi is there, and Siddharth is not there. Siddharth is not there. Okay, fine. Okay, so that's it, guys. We are done.
Hello, Amit sir. I'm Rahul.
Yeah, Rahul. I
Sir,
marked your attendance.
sir, you missed
Excuse me,
my
sir.
name also, sir. Chunky.
Chunky, you're done. You are.
Okay, sir.
Let,
Excuse me, sir. Today's my first class and my name is Shreya.
okay. Let me just do a screen share so that you can see the attendance sheet also. Okay, so Shreya, this is first class, right?
Yes, sir.
Fine, no worries. SHREYA, right?
Yes, sir.
Rotra. Okay. So fine. 20. This is 23rd, right?
Yes, sir.
Fine. Right. So only Siddharth is not there. Rest all are there. So I save it. Okay. So guys, we are done for today, right? So and we'll be doing as in we'll continue with the forward in future only, and thereafter we'll do options. That is continuation of derivative only. So any question before we close for today? Any other question? You're good, right? Okay, so with this, probably we are good to close, and we'll connect again next Saturday, same time, with the remaining stuff that we left on this presentation, and accordingly take it forward with the other stuff that we would be to do, right? So till then, take care, guys. Stay safe, stay at home, and bye bye.
Bye, sir.
Thank you, sir.
Only
Bye.
Bye.